banks have experienced acute stress due to the COVID-19 pandemic across various portfolios, and it has tested the resilience of their risk management frameworks. A key focus has been liquidity risk, where banks saw immediate impact on account of drastically reduced cash flows due to shutdown of large parts of economies across the globe. Banks need to start looking at enhancing their risk management frameworks to not only meet all their obligations in a cost-effective way, but also to adapt to unforeseen stresses.
Banks have traditionally used the structural liquidity mismatch report to base their understanding and analysis of their liquidity. Essentially, the mismatch report summarizes the product-wise cash inflows and outflows as per defined maturity ladder. This gives a good view of the cash flow shortfall across various future time periods like 1 day, 1 week, 1 month, etc. It helps the bank take appropriate funding decisions to cover these shortfalls. The liquidity coverage ratio prescribed by BCBS also relies on this form of structural mismatch to assess the sufficiency of stock of available high-quality liquid asset portfolio to cover net shortfalls over a moderately stressed period of 1 month. In addition, with some assumptions made on the ability of the bank to liquidate its liquid portfolio, another key metric called the survival horizon can also be computed. Survival horizon essentially gives an estimate of the time horizon until which the bank can sustain itself using its internal sources of liquidity, such as cash, liquid securities, asset repayments, etc. However, there are also a number of drawbacks to the static liquidity approach. The fundamental reason being that banks are dynamic entities and their portfolio compositions change on a daily basis. Hence, any analysis that does not incorporate this dynamism is bound to give only a partial or inaccurate picture of the liquidity position of the bank. At Aptiva, we have evolved a risk factor based approach of performing dynamic liquidity analysis that not only takes into account the planned business growth during a period, but also comprehensively covers all sorts of liquidity risk that can have impact on the bank's positions during a given time period. The approach also allows banks to define conditional management actions that are automatically assumed during the dynamic computations based on level of funding shortfall, risk appetite triggers, available liquidity buffer, and prevailing deposit pricing. The first aspect of this approach is to be able to project new business growth and replace maturities at the end of each time bucket with new positions, assuming a slotting profile that reflects the nature of the product. This will then generate a forward-looking gap. Next, we quantify the behavior of key balance sheet line items that impact liquidity. These include realistic assumptions on liquidation and repo haircuts on various liquid instruments, delinquency and prepayment in loan portfolios, runoffs and rollovers on customer deposits, widening of deposit spreads, drawdown behavior on undrawn limits, and devolvement of contingent liabilities like LCs and LGs. Further, we would then define a clear business action like quantum of repo undertaken, freeze on undrawn limits, rollover of asset repayments, source of deposit originations, etc. In this area, Aptiva offers a comprehensive set of advisory and analytical solutions that have helped many of its clients in various geographies to implement effective liquidity risk management frameworks and robust tools to accurately measure and monitor liquidity risk metrics. Aptiva's liquidity analytics platform helps banks streamline and automate a 360-degree diagnostic of their liquidity profile in a holistic way, thereby providing a forward-looking view of its positions under baseline as well as adverse scenarios. This helps banks to plan and prepare better to overcome unforeseen stress situations.
For more information regarding our services, please contact us at info@aptiva.com.